What's going on, guys? Thank you for tuning into this episode of Twin Finance. I am Jackson. Today I'm just going to talk to you about what an income statement is and then go over a few basic terms that you're going to see listed on an income statement. If you want to know where to find these income statements on companies, well, if you're looking at American companies, just go on sec.gov and then you can basically just search up the company. As long as it's publicly traded, they're going to have to file reports through them. So yeah, basically all the publicly traded companies that you'll see on American stock exchanges are going to have reports filed through the SEC. In Canada, you can just Google the company. I'm drawing a blank on the name of the research database for the company filings. I'm not sure if there is one. But yeah, anyway, basically if you Google any company and you go to their investors or their business link on there, you should be able to see 10Ks, 10Qs, all their financial reports, things of that nature. So I'll just get right into it. So income statement, basically an income statement is pretty much exactly what it sounds. I'm just going to do this, short format. So income statement. So basically it is what it sounds like, guys. This is just going to show you what the company earned on the year, how much they sold, their cost of goods sold, all the things of that nature, and then somewhere at the bottom you should see their dividend, how much they paid per dividend. It'll show you earnings per share, things of that nature, guys. So basically that's what it entails. I'll just run over a few quick terms for you that's going to be the really important ones. Obviously each company is going to have some different expenses and stuff like that. They're going to have different names for each of their expenses. So I'm just going to run through basically the big terms that you're going to need to understand if you want to know what you're looking at. So right off the bat on the top line, you're going to see revenue, or this could also be called gross sales. So basically this is just all of the goods sold by that company. So basically all of the goods sold. So basically whatever money came into that business this year, wow, that's basically the amount of business they did in the marketplace, guys. So that's just what revenue is real quick. That's just the amount of products sold. So say you walk into a grocery store, you buy something for $20. Well, that $20 is going to go in on the revenue. That's before expenses and everything, right? So then after revenue, you're going to see cost of goods sold. Cost of goods sold. And that's basically just your overhead expense, guys. So that's the purchasing of the goods. So purchasing, say, grocery store, they would have to purchase goods from the supplier, get them sent to them, and then they would have to sell them. This is just the cost of the goods. And then you're looking at the revenue minus the cost of goods sold, which you're looking at your gross profit. So your gross profit should be right underneath this one. So it's gross profit. Gross profit is just revenue minus cost of goods sold. So that's their gross profit on the year. That's how much they bought the goods for and how much they sold them for. This is before the next expense that I'll get into. You know what, I'll just erase it and then we'll go over that real fast. So after you have gross profit, you're going to see you're going to see sales expense, administrative expense, like that, right? So this is like basically all the costs that they had to pay employees, all the commissions and everything. So you're going to see, depends on the income statement, could just be called cost of sales. So this could just be the sales charge that the company, paying the employees, all the things of that nature. So then you're going to get a number, the dollar amount, obviously. Then you're just, if you want to see their net income after that, obviously you're going to get, like, you might have some non-recurring expenses or whatever showing up right underneath here. But then basically the next real important one that's going to show up on pretty much every income statement is net income. Not net income. Net income before interest and tax. So I'm actually going to erase that. So we'll see this. We'll see earnings before interest and tax, or it could just be called earnings before interest and tax. Like they might have the whole thing written out. Chances are it's not gonna. But yeah, and another common name for this one, guys, is also operating income. So that's just their operating income before any taxes, any interest they had to pay, like bond interest. Obviously if they have bonds issued, they're gonna have to pay interest on that. So earnings before interest and tax, exactly what it sounds. So you're gonna get a dollar value out of this one too, and then this is your basically your bottom line. So After this, you're going to have interest expense. So you have your interest expense. So on any bonds issued or loans, right? So you're going to have interest expense. You're going to have interest expense, sorry, then you're going to have income tax expense. So income tax expense. And then once you get through these two things, the last one that's pretty much important is net income. That's the final number. That's what a lot of shareholders and stuff use to evaluate whether a company's, worth buying and stuff like that. So that's the net income. That's after everything's all said and done. What did the company net on the year? What's the money they're looking at? What's the cash flow they're going to have from that? So that's what they're looking at. So net income. Obviously, after they calculate their net income, they have to pay back their shareholders if they pay a dividend. So obviously that dividend comes out of the net income. But so that's where you stand. So the net income, and then below net income on the income statement, I'll just write over here in another color. You'll see something called earnings per share, or EPS, and then you'll see basic with a number, and then you'll see diluted with a number. So basic earnings per share is just take this net income number, divide it by the amount of common shares currently on the market, and that's your basic earnings per share. Diluted, on the other hand, is any outstanding stock options that employees or ex-employees or executives currently hold. If they were all exercised and turned and converted into common shares, then that's the earnings per share that would be outstanding. Because if all those options were converted into common shares, there would be more outstanding common shares in the marketplace. So the earnings per share would be diluted, so therefore it would be less. So the diluted earnings per share is always going to be less than the basic earnings per share. If they're the same, then that just means there's no outstanding stock options and stock warrants and stuff like that outstanding within the company, guys. So make sure to look at the diluted earnings per share also, because that could be key. If they have a lot of options, they're all converted that year, their earnings per share could be affected significantly. So these are just the basic terms on an income statement. If you have any more questions about other items listed on the income statement, feel free to drop them in the comment section below, and I'll get back to you as soon as possible. I hope this video cleared up, basically what an income statement is and how they work. Thank you for watching this video, and have a great day.